Yardeni is joining us now, President at Yardeni Research. Ed, good to have you with us here. Thanks for waiting. Quick thoughts, Ed. What did you make of the policy, and what are the implications for, equity markets around the world?
Right. Well, as you said, nobody was really surprised that they decided to skip raising the interest rates at this meeting. But the big surprise was that they indicated that they will be hiking interest rates some more. I thought that, I wasn't really that surprised. I thought that they would take a hawkish position on the future while taking a relatively dovish position for now. I'm not convinced that they're going to be doing two more rate hikes. I think between now and the next meeting in late July, a lot can happen. And I think we're going to continue to see moderation in the inflation rate, moderation in the labor market. So I don't really know that more rate hiking is actually necessary.
Okay, more rate hiking may not be necessary, but that's the indication that the Fed has given. What does this mean for risky assets like equities? Ed, how do you see equities shape up in the latter half of the year, given that on one hand there could be rate hikes, and on the other hand there is still all that talk about the impending recession? What's your view now?
Yeah, well, the market's done quite well since October 12th. Then there was some concern with the banking crisis back in early March that the market rally narrowed to basically the mega cap 8 stocks, and everything else was kind of languishing. But in the past few days, so far in June, actually, we've seen the market broaden out. I think it had a lot to do with the employment report that showed that just another piece of evidence that there isn't a recession out there. So I think if the economy continues to show its resilience, its ability to grow in the face of this tremendous increase in interest rates, I think investors will embrace that. And I think you'll see the stock market continuing to move higher. I have 4,600 on the S&P 500 by the end of the year. I hope it rests, and I hope it broadens out. And I think both of those are likely.
Mr. Yardeni, good morning. So if the Fed does continue to deliver more rate hikes, as Jay Powell indicated yesterday, while the market incrementally might sort of take that as a sign of a positive economy, what about the accidents along the way? Not too long ago, we were talking about all the mid-sized U.S. banks. More rate tightening, couldn't that complicate the story a little bit? Will it be really as much a simple straight line as the Dow and the S&P is simply heading higher?
Well, I think they just wanted to get verbally the perception that they haven't given up on the inflation fight, that they're not satisfied yet. Powell said a few times, Fed Chair Powell said a few times that the core inflation rate's been sticky. He didn't really mention the fact that a lot of that is because of rent inflation. And we know that rent inflation is going to be coming down. So I think, again, I don't think they're going to go for that two more rate hikes. I'm not even sure they'll go for one more rate hike. And I think one of the reasons is the one you mentioned, and that is we've came very close to a severe banking crisis. We don't want to push that again too hard. And let's not forget that the banking crisis probably means that credit conditions have been tightened somewhat.
Before we let you go, one final word on how you're approaching emerging markets like India, because the situation here has improved quite a bit on the macro front, whether it's inflation cooling off, growth picking up, earnings have picked up now. So a lot of tailwinds for the Indian market. Do you think India could, rise to the top of the pecking order for the second half of the calendar year?
We've talked about this, several times as I've appeared on your program. And I've consistently been bullish on India, mostly because of the entrepreneurial spirit, the capitalism that exists in India, but also because on a global basis, when you're looking for big markets to invest in, India stands out. As I've previously indicated, I'm not a big fan of China, mostly because of its autocratic government regime where the rules for business can be changed willy-nilly. And as we can see, the Chinese government is actually struggling to get their economy to grow a little faster. And that's partly because they've created this big property bubble that's continuing to lose air.
There are political problems as well in terms of geopolitical, rather not internal political, but between the US and China. So people voting with their feet, as we've seen in some instances recently. Ed, good to speak with you. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. Thank you. We'll take a quick commercial break here. Our list of top stocks to watch with our research team coming up in just a bit.